My name is Ray.
Hi, this is Michael.
Welcome to another episode of Ray's Economic Book. Today, we're talking about the loanable funds model and talking about how interest rates in the loanable funds work in its own market almost.
Okay.
So to begin with, let's look at a supply for loanable funds and the demand for loanable funds. Look at the individual curves. Okay. So for loanable funds, basically funds that are loaned to mainly to businesses and are supplied from savings in an economy. Basically, the savers supply more, obviously, if the interest rate increases, because then their opportunity cost of holding money is basically increases to the point where it may break their personal threshold and they choose to save money and retain the interest rate. And so the savers' supply increases, the interest rate supply increases, which means that shifts of supply curve are shifted by different amounts in capital inflow, foreign capital inflow perhaps, and also private domestic saving behavior, which is closely tied often with business cycles.
For example, maybe just people all of a sudden becomes just like they prefer more fresher food. They prefer now saving more. Okay, just the mentality changes.
When that happens, the supply curve will shift right.
Of course.
And demand is basically caused by your profitability. Basically, if interest rate increases, your your costs for perhaps a business venture or a business loan increases. Your profitability off that loan, off of what you spend the loan on, it decreases.
That's actually demand curve move along this way is pretty intuitive because look at when the interest rate goes lower. Okay, of course the profitable projects will be, the number of projects
funded from the loan are more profitable because your costs decrease because the interest rate, which is your one of your costs, decreases.
Business has more project to demand the loans.
And so the demand curve shifts according to government borrowing because governments borrow from the loanable funds market, perhaps to cover their own deficit and deficit spending. And so this creates a case where it can crowd out other private investments because as government borrowing increases the demand, your interest rate increases to the point where a private investment is too costly for many businesses. And so, of course, perceived business chances, your perceived profitability or revenue made off of a business venture funded by a loanable fund is funded by a loan. Can shift the demand curve. You have more confidence in perceived business chances in your economy, which typically comes during economic expansion. Your demand increases.
So again, I want to stress, we need to know the difference between move along and shift. So move along usually just means the interest rate goes lower. There is more demand for loanable fund, and the interest rate goes higher. There is more supply for the loanable funds. Okay. And shift usually is external force. Okay.
So let's look at the equilibrium of loanable funds market. So basically, at equilibrium, basically is obviously when supply and demand meet. So in this case, let's say equilibrium is 8%. So at 8%, basically, lenders willing to lend at lower than 8%, of course, get their loans accepted. Lenders willing to loan only at greater than 8% are not able to have their loans accepted. The offer is not accepted, which means that projects with a rate of return of 8% or greater, in which case they're profitable, they do take a loan, and projects with a rate of return less than 8% are not funded because they are losing based on the loan. And so basically, we previously talked about how savings and investments, basically in a closed economy, investments equals national savings, but in an open economy, which is the U.S. economy, natural savings plus foreign investment or capital inflow equals our total investments. And so that relates greatly to our loanable funds market.
That's actually the foundation for our loanable fund market. Although it's a hypothetical market, it actually highlights the importance of the how the money from the move from the savers to the corporation and the government.
Because our national savings are basically making up our loanable funds market.
Right here. Okay.
And so with the loanable funds market, there's one very important and critical effect or theory that's also very well accepted, the Fisher effect, by
Irving Fisher,
derived by Irving Fisher, the very famous economist. Basically, he theorizes that the most important factor affecting interest rates over time is changing expectations over future inflation. Which means that the shifts in both the supply and demand for loanable funds are shifted, but they're not shifted left and right. They're shifted up and down according to the interest rate changes, but the quantity of loan is not changed because the real interest rate is not changed. The Fisher effect says that expected future inflation leads to the same amount of an increase in the nominal interest rate. So let's say if you believe if there would be 5% inflation in the future, your nominal interest rate increased by 5%. So the real interest rate remains unchanged because according to Fisher's formula, the real interest rate equals nominal interest rate minus expected inflation rate. So even if inflation and nominal interest rate increases, your real interest rate and basically your real returns for demand is unchanged.
Yeah.
So this is why our quantity loan does not change, but our supply and demand shift up and down according to the interest rate, because nominal interest rate changes. Now this formula is not 100% correct, but is very close to what happened, what we believe happens now in the real economy.
Yeah.
So an example of this, let's say we have an expected inflation rate of 10% in the future.
Yeah.
And so basically what happens is nothing happens except everything shifts up. Basically, our new equilibrium is at 14% at the same quantity loaned, and so at any given Q, supplier and demand adjust because they adjust because their real interest rate is the same, but their nominal interest rate is increased to keep the real interest rate the same under rising inflation.
Yeah, for those kind of all of the jump, the expected inflations actually usually the contract already embeds those kind of clause that the nominal interest rate will increase. Pretty much by the same amount.
Michael mentions a very good point. Interest rate is often embedded within loan contracts, which can, to an extent, also account really well for unexpected inflation that is not pre-estimated by the market.
Yeah, for example, all of a sudden there's an oil embargo again. So
this massive inflation can be accounted for in the contract.
Yeah.
So for our final clues, loanable funds market is all about investment demand. We talk about investment. We don't talk about investment financial market, stocks and bonds or whatever. We talk about investments
in physical goods.
Loans from businesses they used to invest in capital, invest in expansion, such as Walmart perhaps opening more warehouses, or Amazon more warehouses, or some more factories, etc. So loanable funds and demand are supplied from savers make up this market. So ICE investment in physical goods, government investment spending can increase interest rate through increased demand, which crowds out private investment at times. And the Fisher effect we just mentioned is very important. It just indicates that real interest rate stays the same at equilibrium, but nominal interest rate increases with expected inflation.
Yeah, I think that's basically the loanable fund market again. It's different from money market as we discussed. But the thing is, basically, it's based on the saving investment identity. And although this is a hypothetical model, it actually provides enough insights on how the money moved from the savers to the demanders. Okay, in a free market, right? Okay. So today next we're gonna discuss actually how loanable funds can be connected with the money market fund. Okay, as we discussed before. Okay. See you guys later. Bye bye.